Welcome to the Deep Dive. We're the show that cuts through the noise to bring you clear, actionable insights. Today, we're jumping into something really fascinating and honestly increasingly vital. It's all about how companies measure, report on, and crucially, assure their environmental, social, and sustainability efforts. We've got some great sources lined up to help us understand why these reports are popping up everywhere, why measuring sustainability is so darn difficult, and what role auditors play in verifying it all. Okay, let's unpack this.
Exactly. And this whole area, it often falls under this umbrella term, Extended External Reporting, or EER. Basically, it covers all those reports about a company's social, environmental, that kind of thing. And you're right, it's becoming mandatory for more and more companies, listed ones, big private ones. Assuring this kind of data, though, that's a real specialist area. Our goal today is really to look behind those often heard green credentials and see what's substantial.
Okay, so let's start right there. Why are companies doing this? What's the real push? Is it just, good PR, or is there something deeper driving it? This is where it gets really interesting.
It's definitely more than just PR, though. That can play a role, especially with voluntary stuff. Our sources really point to three main things. First up, national reporting requirements. Governments are mandating it. Think about the EU's Corporate Sustainability Reporting Directive, the CSRD. That forces large companies to publish reports on their social and environmental impact. It's law.
Okay. So regulation is a big piece.
A huge piece. And it's not just the EU. You see similar moves in the UK, New Zealand, Japan particularly, for premium listed companies. They need to report against the TCFD Framework Task Force on Climate-Related Financial Disclosures.
TCFD, right. Heard of that.
So that's one driver. The second is stakeholder needs. Big investors, like pension funds, they're asking for this info now. They want to know about the company's environmental footprint, its social impact. It's seen as part of understanding the company's long-term prospects and risks.
So the money is demanding it, basically.
In many cases, yes. And the third driver is voluntary disclosure. Some companies choose to report this stuff. They see it as a way to get a competitive edge, show off their green credentials.
But you mentioned a nuance there.
Yeah, the tricky part with voluntary reporting is that because the rules aren't set by law, there's potentially more room for, let's say, management bias in how they present things.
That makes sense. If you're choosing what to report and how, you might emphasize the positive.
Precisely, which is exactly why assurance becomes so important, even for those voluntary reports. It adds that layer of credibility.
Right. And you hear the term integrated reporting sometimes, IR. Is that related to all this?
Absolutely. Integrated reporting, IR, has been around for maybe the last decade or so. It's all about giving a holistic picture, combining financial and non-financial performance. The idea is to show how a company creates value over the long term, considering all these different factors. So yes, very much connected to this broader push for transparency.
Okay, so we've got the why. Mandatory rules, investor pressure, sometimes voluntary efforts. But now, the how. How on earth do companies measure something as broad and, frankly, fuzzy as sustainability? And then, how do you audit that? It feels like trying to measure smoke sometimes. So what does this actually mean in practice?
Yeah, this is the really challenging part. Our sources highlight some big problems here. The main one, a real lack of uniformity. Companies, even in the same industry, might report the same sustainability indicator in totally different ways. There just isn't one single global standard everyone uses. Lots of different frameworks floating around.
So comparing company A's environmental impact to company B's is
extremely difficult. It's often apples and oranges. And the standards themselves are still evolving, like the International Sustainability Standards Board, the ISSB. They just started consulting last year on 2 proposed standards, one general, one specifically on climate. So progress is being made, but we're not there yet.
Which means trying to benchmark companies or even track progress over time must be a nightmare.
It definitely creates huge challenges in comparison. You've got requirements changing quickly, a huge diversity in what's being reported, from carbon emissions to employee equality, no single reporting basis. And as we mentioned, that risk of management bias creeping in, because measuring this stuff, choosing the criteria, it can be quite subjective.
It sounds like a data explosion too. How many things can they even measure?
Oh, tons. Think about the UN's Sustainable Development Goals from 2015. Then the OECD published over 200 key performance indicators, KPIs, just back in 2021. These KPIs cover everything. greenhouse gases, waste, resource use like oil or forestry, supply chains, water pollution, employee welfare. The list goes on. And it varies by region, industry, company.
Wow. Okay.
And then there's the presentation. It's all over the place. Some use tables, some use narrative descriptions, some use non-financial numbers. This inconsistency in the measures themselves, how they're shown, how they're quantified, makes real like-for-like comparison, even within the same sector, incredibly hard.
Okay, so it's a complex, messy landscape of data, which brings us back to the auditors, the assurance providers. What's their role when they're faced with all this inconsistency and subjectivity? What does an assurance engagement actually look like here?
Well, an assurance provider might get involved in a couple of ways. They could be asked to review this EER information as part of the company's standard annual report.
Okay, like alongside the financial audit.
Sometimes, yes. Or it could be a completely separate job. An independent assurance engagement focused only on the non-financial sustainability information. A big challenge here is something called the expectation gap risk.
Expectation gap. What's that?
It means that some people reading the annual report, investors, the public might assume that all the information in it, including the sustainability stuff, has been audited to the same depth as the financial statements. But that often goes beyond what traditional financial auditing standards like ISA 720 actually cover for that other information.
So users might think the auditors have scrutinized the carbon emissions data just as rigorously as the revenue figures, but that might not be the case.
Exactly. That's the gap. So it's absolutely critical for assurance providers to be crystal clear. They need to spell out the limitations of their work, what they did, what they didn't do, right there in the engagement letter and in their final report. Managing expectations is key.
So they're essentially saying, we looked at this, but here's the scope. Here's what this opinion actually covers.
Precisely. It's about transparency regarding the assurance itself. So you generally see those two main types: the review within the annual report audit or a standalone assurance engagement on the EER data.
It really sounds like auditors need to be adaptable, applying traditional auditing ideas to this very new, very different kind of information.
They absolutely do. And what's fascinating, really, is how they apply existing audit standards, which were mostly designed for financial information, to this non-financial world, despite all those challenges we talked about, the lack of uniformity, the subjectivity.
Right. And our sources mention some specific standards that come into play. Can you walk us through a few of those and how they apply here?
Sure. Let's take ISA 540, which deals with auditing accounting estimates. This becomes really relevant for sustainability data. Think about calculating future emissions reductions or the cost of environmental remediation. These are estimates. And there's a risk of management bias, especially if the company is reporting voluntarily to boost its image.
So the auditor has to question how they came up with those numbers.
Exactly. And it's harder when there aren't clear industry benchmarks for those calculations. The auditor needs to assess if the methods and assumptions are appropriate. Then there's ISA 250, which is about considering laws and regulations. If sustainability reporting is legally required, like with the CSRD,
then getting it wrong has legal consequences.
Right. Failure to report correctly could mean fines, penalties, reputational damage for the company, and potentially the auditor. And breaches themselves, like failing to make required environmental disclosures, could impact the financial statements, maybe needing a provision for fines or even affect the company's license to operate.
Okay, that makes sense. What else?
Well, ISA 315, which is all about identifying and assessing risks of a material misstatement. For ER assurance, this is huge. It means the assurance providers need deep knowledge, not just of auditing, but of the specific industry and the subject matter, like climate science or waste management.
So they might need to bring in outside help.
Very possibly. They might need independent experts, specialists in greenhouse gas measurement or chemical analysis, maybe even dedicated ER experts to lead the engagement. They also have to look hard at the company's internal controls. Are the systems for capturing and reporting non-financial data as strong as those for financial data? Often they're not.
Yeah, that seems likely.
And they have to think about data coming from outside the company, environmental agencies, suppliers, carbon offset registries. How reliable is that third-party information? That takes professional judgment.
Trusting the source.
And one more, ISA 450, evaluating misstatements found during the audit. Here, auditors need to think about omissions. What if the company doesn't report the potential impact of, say, business interruption from a pollution incident or environmental damage cleanup costs, or even strikes related to working conditions? The auditor has to judge if leaving that information out could mislead the users of the financial statements.
That really drives home the point about needing to trust the data, whether it's cooked up internally with maybe weaker controls or brought in from outside sources.
Okay, let's unpack this. How do auditors actually gather the evidence? What do they do on the ground? Okay, so if we tie this back to the fundamentals, it's about getting enough good evidence. They use the core principles from standards like ISA 500 on audit evidence. This means designing specific tests, substantive procedures to try and detect potential misstatements in all this sustainability information.
Can you give us some practical examples? What would an auditor actually be looking at or asking about?
Sure, they might start by reviewing the financial statements themselves. Are there any fines booked for environmental violations? Any unusual legal expenses related to regulatory problems? That can be a red flag.
Connecting the non-financial claims to the financial reality.
Exactly.
Yeah.
They'd also assess the financial impacts of waste. They might ask management about waste disposal costs. Are they going up? Are there government recycling incentives showing up as income or reduced costs? They'll also keep an eye on external information, reading the news, checking industry publications, maybe even monitoring social media or whistleblower sites for any significant environmental or social issues related to the company.
So looking beyond just what the company tells them.
Absolutely. And analytical review is key here too. For instance, if a company reports its waste levels went up, does that correlate with higher material costs or changes in production volume? They look for inconsistencies. If cost per unit goes up, or if more raw material seems to be needed for manufacturing, that might warrant further investigation into the waste figures.
It sounds like detective work piecing together different bits of information.
Can be. And underpinning all of this is professional skepticism. Auditors really need to challenge management's explanations and the reported numbers. This is especially true when these reports are being used by external parties, banks making lending decisions, governments issuing permits, maybe licensing bodies in regulated sectors. You can't just take the figures at face value.
And any significant problems they find?
Those get reported up the chain to those charged with governance, usually the board or the audit committee. They need to be aware of any major issues or risks identified.
It really highlights that this isn't just a check-the-box exercise. It requires real expertise, especially since, as you said, EER and sustainability reporting is such a rapidly changing specialist field.
Okay, this has been a fantastic deep dive. It really brings home just how complex this whole area of sustainability reporting is, how important it's becoming, and how much it's still evolving. And crucially, how ensuring the assurance part, making sure that information is trustworthy, is absolutely critical. It's not just about what companies claim, it's about whether you can actually rely on those claims.
Precisely. And, this raises a really important point. This field, EER assurance, it's moving so fast. The people doing this work need constant training, constant development of their expertise. The implications are huge because, as we've discussed, everyone from investors to regulators to consumers are starting to rely on this non-financial information to make pretty significant decisions.
So here's something to think about, a final thought for you, our listener. Given all these challenges we've talked about, the measurement difficulties, the evolving standards, the complexities of assurance, what does it mean if you or big investors or regulators are relying on sustainability reports that haven't been robustly assured? How can you personally approach the sustainability claims you see from companies with a more critical, more informed eye, knowing what actually goes into trying to verify them?